August 1st, 2012, 9:30 a.m. A routine trading day begins, but in 45 minutes, one company will lose $440 million. Knight Capital Group, one of Wall Street's most powerful players, the invisible giant behind millions of trades. From this Jersey City headquarters, Knight's traders moved billions of dollars daily through lightning-fast transactions. Knight dominated American stock trading, with a market share of roughly 17% of the New York Stock Exchange and 17% of NASDAQ. While Manhattan's skyscrapers grabbed headlines, Knight's Jersey City operation quietly controlled vast portions of the market. Every single day, Knight Capital executed 3.3 billion shares worth over $21 billion in trades. CEO Thomas Joyce led Knight Capital with transparency and bold leadership, qualities that would soon be tested. Knight was a market maker, profiting on tiny spreads between buy and sell prices, multiplied billions of times. When you traded through TD Ameritrade, E-Trade, Fidelity, or Vanguard, Knight Capital likely executed your order, worth $1.5 billion with $365 million cash. Knight seemed financially invincible in summer 2012. Behind Knight's success was SMARS, a powerful algorithmic system routing thousands of orders per second. SMARS split large parent orders into optimized child orders, comparing prices across dozens of venues instantly. But buried in Knight's code was PowerPeg, an old test program from 2003, deprecated and forgotten. PowerPeg was designed to lose money intentionally, buying high, selling low, testing other trading systems. For 9 years, this dangerous code sat dormant in production servers, a ticking time bomb. PowerPeg's logic was inverted, programmed to do the exact opposite of profitable trading. In 2005, engineers moved a critical counter in the code, accidentally breaking PowerPeg's safety mechanism. The safety counter that stopped PowerPeg from infinite loops was now disconnected. Orders could run forever. When PowerPeg tests began failing after the refactor, engineers made a fatal choice: delete the tests. June 2012, NYSE launched the Retail Liquidity Program, giving Knight just 30 days to implement new functionality. 30 days to build, test, and deploy major changes, an impossible deadline that forced dangerous shortcuts. To save time, developers repurposed the old PowerPeg flag. New RLP code would use the same binary switch. Knight had 8 SMARS servers. 7 would get the new code perfectly, but 1 would become a weapon. July 27th, late night. A technician manually deployed code, SSHing into servers one by one. No automation. The deployment script had a fatal flaw. If a server was unreachable, it failed silently and reported success. 97 automated emails warned PowerPeg disabled between 8:01 and 9:30 a.m. on August 1st. Nobody noticed. The NYSE chairman tried calling Thomas Joyce, but Joyce was home recovering from knee surgery. No answer. 9:30 a.m. August 1st. The opening bell rang. Markets came alive. Knight Capital began receiving RLP orders. 7 servers processed orders correctly. Server number 8 activated dormant PowerPeg code. Disaster had begun. Because the safety counter was broken, PowerPeg couldn't recognize orders were filled. It kept sending more endlessly. Server number 8 executed PowerPeg's deadly logic thousands of times per second. Buy high, sell low, repeat. Wizard software stock erupted, surging 321% from 350 to 1476 in minutes of insane trading. Knight's trading floor erupted in panic. Screens showed losses mounting. Nobody understood what was happening yet. 15 minutes in, millions of dollars hemorrhaged as the algorithm executed its profitable opposite, losing money on every trade. Engineers frantically typed, searching logs, analyzing code, trying to diagnose the problem while the market hemorrhaged. 9:58 a.m. After identifying the root cause, engineers finally shut down SMARS. The bleeding stopped. Total damage: $440 million lost in just 45 minutes of uncontrolled algorithmic trading. Those 45 minutes saw Knight execute 4 million trades across 154 stocks. Complete market chaos. Knight ended up with nearly $7 billion in unwanted positions, $3.5 billion long, $315 billion short. The stock price collapsed from $10.33 to $3.29, a catastrophic 75% drop in 2 days. Knight's largest customers, TD Ameritrade, Vanguard, Fidelity, immediately halted order flow. The business was bleeding out. Thomas Joyce appeared on Bloomberg TV, taking full responsibility. Technology breaks. It ain't good. We don't look forward to it. Joyce's transparency was remarkable. No deflection, no excuses, just honesty about the catastrophic software bug. The math was brutal. $440 million in losses, but only $365 million cash on hand. Knight was technically insolvent. Goldman Sachs stepped in to buy Knight's $7 billion unwanted position at a price that cost Knight $440 million. In an emergency weekend boardroom, Knight's executives scrambled to find rescue financing before Monday's market open. 48 hours after disaster struck, Knight closed a rescue deal led by Jefferies Group. 6 firms invested $400 million to save Knight: Jefferies, Blackstone, TD Ameritrade, Getco, Stifel, General Atlantic. The rescue consortium would own over 70% of Knight's equity. Existing shareholders massively diluted. Knight survived, barely. The company stayed afloat, but its independence was already ending. The SEC launched a comprehensive investigation into Knight's violations of the market access rule. October 2013. The SEC fined Knight $12 million for failing to maintain adequate trading controls. Knight violated critical requirements: no pre-trade risk controls, no kill switch, no verification checks, no monitoring. 2 suitors competed to acquire the wounded Knight capital, Getco, from Chicago, and Virtue Financial. December 19, 2012, Knight's board unanimously chose Getco's $1.4 billion merger offer. The merger created KCG Holdings. Knight Capital's name would disappear. Its independence ended. Thomas Joyce resigned immediately after the merger closed, collecting a $7.5 million retention payment. Joyce's corner office, once commanding Knight's empire, now sat empty, packed boxes marking the end. In less than 1 year, Knight Capital went from disaster to rescue, to merger to extinction. By July 2013, Knight Capital ceased to exist as an independent company. 17 years of history ended. A corporate memorial for Knight Capital, founded 1995, destroyed by 45 minutes in 2012, absorbed 2013. The disaster exposed what proper deployment should look like: automated testing, peer review, staging, verification, production. Every trading system needed a kill switch, one button to stop everything instantly during emergencies. Real-time monitoring with proper alerts could have caught the problem within seconds instead of 45 minutes. The lesson was clear. Technical debt isn't just inconvenient, it's a loaded gun pointed at your company. Old code must be deleted, not just deprecated. PowerPeg should never have remained in production. Universities now teach the Knight Capital disaster as a cautionary tale about high-frequency trading risks. The industry faced a fundamental tension: the need for speed versus the requirement for safety. Knight's failure revealed systemic risk. One company's bug could ripple across entire markets instantly. From the 2010 flash crash to Knight to future disasters, the pattern of technology failures was accelerating. Regulators responded with new requirements: mandatory testing, certification, kill switches, better oversight of automated trading. The vision of tomorrow: trading floors with advanced AI-assisted systems but comprehensive safety controls built in. Before Knight, chaos and manual processes. After Knight, automation, verification, and safety became industry standard. Despite the disaster, Thomas Joyce earned recognition for transparent crisis management, a leadership lesson preserved. In high-frequency trading, the butterfly effect is real. One forgotten flag can trigger financial tornadoes. One keystroke on July 27th deployment, one forgotten server, one repurposed flag destroyed $1 billion company. Modern trading, requires layered protection. Algorithms, controls, monitoring, regulations, testing, all working together. The path forward was clear. Test everything, delete old code, automate deployment, monitor constantly. Wall Street's future mixes classical finance with advanced technology, but safety must keep pace with speed. In milliseconds, a single LED can shift from green to red. Disaster moves at machine speed. Financial. Markets are chess games, where one fallen piece triggers cascading failures across the entire board. $440 million locked away forever. Losses from those 45 minutes can never be recovered. The solution requires collaboration, code review, testing, monitoring, controls, all pieces working together. The Knight Capital case study is now required reading for engineers building financial trading systems. Today's computer science students learn from Knight's mistakes, ensuring the next generation builds safer systems. The industry faces a choice: embrace automation and safety, or continue with risky manual processes. Comprehensive protection requires multiple defensive layers. No single control is enough to prevent disaster. Like a lighthouse guiding ships through storms, Knight Capital's story illuminates the path towards safer, more resilient financial markets.